And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week as we get ready to wrap it up. It's The Real Investment Show, of course. I'm your host, Lance Roberts. Of course, Brent Clanton driving our Link Challenge bus. As always, we're going to see if we can make it safely to school this morning. Did you ever see that for you older people in the audience like me, right? You remember the movie Gumball Rally?
Yes.
With Dom DeLuise and Burt Reynolds, right? So, of course, that was when the Italian driver was in the car and he rips off the rearview mirror and he throws it out the back of the Ferrari. He says, "What's behind me is not important." Well, the way Brent drives, what's in front of him is not important either. So that's the important thing.
Hey, now.
So my wife and I were watching Smartest Guys in the Room last night.
Yes.
So we're kind of on a documentary kick here lately. I just trying to find new stuff to watch, I guess. But I'd seen this movie before, but I'd forgotten. Of course, we had Beth McLean on our show here before. We've interviewed her as well. But when Enron was going down and all this, this was right in the midst. I was actually doing a radio show on another station with Mr. Brent Clanton at the time, as he was my boss at the time. And we were right in the midst of this, this Enron meltdown. And I had forgotten at the time. I remember the whole, deal about Enron broadband, right? Enron had this idea of trade, unused broadband. They were going to trade unused broadband capacity like a commodity.
Right.
And part of their deal is they launched a streaming service with Blockbuster Video, and I had forgotten about this, right?
Yeah.
And
I remember talking to Ken Lay, and he's describing how we would watch television on the internet, and everybody go, "You're nuts."
Yeah, you're nuts. And what's interesting is that had they gotten that thing to work, right, they would have been the Netflix.
That's right.
Enron would have been Netflix. And Blockbuster would still be around. And unfortunately, they just could never get it to work right. But they had the right, it's interesting, when you take a look at it, Enron's this kind of giant fraud. It really was. There was a lot of accounting machinations and just, BS accounting really kind of across the board. And it's amazing. They sucked in Vincent and Elkins here in Houston, which is a major law firm. They sucked in Arthur Andersen into their scheme. It's a fascinating story. If you haven't watched the documentary Smartest Guys in the Room, it's well worth to see kind of the links that they went to get stuff done. But out of this malaise of ideas they were generating to basically kind of manufacture money, they actually had a really good idea that would have worked. And as art imitates life, CNN tried to replicate this whole service as well by launching the Comedy News Network streaming service, which was on Tuesday.
Yeah.
Employees are now bracing for layoffs as soon as May, as subscribers are not subscribing. Hey, I have an idea for CNN. Try reporting news, unbiased, fact-based news, and maybe people actually subscribe to pay for it because there's not really any good news services out there anymore.
What a silly idea.
I know. I miss the days of actual news. Remember when you used to sit down with your dad and watch the news at night?
Yeah. Walter Cronkite.
I'm Walter Cronkite.
And that's the way it is.
And that's the way and it was just news. It wasn't biased. Yeah. It was just the facts. And miss those days.
Yep.
Actually having good news.
That was the golden age.
Now, the world's in trouble when the real Comedy News Network that actually has higher ratings than CNN, right?
Yeah.
So this is the thing, the Comedy Channel, higher ratings. It just shows you. And sorry?
When the Babylon Bee breaks news,
exactly.
We're in trouble.
Yeah. Or when people are getting their news source from The Simpsons. This is the other. Of course, Simpsons was right on this. I mean, The Simpsons have a primitive, have an ability to really kind of bring the future into focus. They've kind of nailed a lot of stuff.
All humor is rooted in truth.
Right. Absolutely. Anyway, a couple of things here to get the show started today as we digressed. Markets are ending up the end of the quarter now, despite the fact that we just had a 10% rally over the course of the last 2 weeks. Markets are going to end the quarter lower, most likely, unless we just have a phenomenal rally today, which is unlikely to be large enough to get us to a positive quarter. We're going to have a negative quarter now. That's not the end of the world. It's just the way it is. But it definitely has been a rough start to the new year. Now, as we get into April, April tends to be a much better month. Seasonally speaking, April tends to be positive. Over the last 15 years, it's been positive. Over the last 16 years, it's been positive every time except 1 year. So, it's not surprising we will see a little bit of carry through into next month, but not before getting some type of sell-off here, at least in the short term. So some corrective action here is very likely. The S&P, again, as we've talked about the last couple of days, is extremely extended above the 50-day moving average. So, we're 2 standard deviations above that moving average. It's been a big run over 2 weeks. And just from a logical standpoint, markets are going to have to, take a bit of a respite here and at least just trade sideways, if not at least pull back to these levels of support. So now the 50 and 200-day moving averages are now really key technical support for the market. I'd say the 200-day moving average is even more important right now, that if the market does pull back here over the next few days, it needs to hold that 200-day moving average. Markets are very overbought on every measure, and we're very close to triggering sell signals on 2 of our most important indicators. So again, really, no matter how we kind of look at this, markets need to have a bit of a correction here to work off some of this overbought condition. Now, that'll give you an opportunity to put some money to work in the markets as long as other factors right now aren't deteriorating even more. So as long as kind of everything remains status quo, there's not a lot to worry about here, but we definitely need a bit of a pullback here in order to allow for an opportunity to put a little bit of money to work back into the markets. On the other side of that ledger, though, is paying attention to fixed income. And this is something that Mike and I will talk about more this morning. But bonds have been very oversold here and are actually turning a little bit positive here. We're starting to see kind of a top in interest rates and a bottom in bond prices. And importantly, we're now triggering buy signals really across the board from fairly low levels. So again, there's a good idea here that we're going to get a correction in stocks to some degree. Again, not major. We're not going to go back down and retest lows most likely, but have some type of a short-term correction in stock prices. Money moves in, rotates out of risk into fixed income. And that would not be a surprising trade here, particularly as people become kind of a little more concerned here about the potential for the Fed hiking rates, slower economic growth, that type of thing. That, if we start to see that impact of weaker economic data starting to filter through into the economy, we'll start to see more money kind of rotating into that safety trade on the bond side. So again, we had added a little bit of bond exposure earlier this week, and that continues to kind of be the case here, to look to add some of that longer duration bond exposure as a hedge against the equity risk we have in portfolios right now. But of course, we're still carrying a good bit of cash. But if markets do kind of consolidate here, hold support, start looking a little bit more bullishly biased, then we'll put that cash back to work. But we've got a lot of stuff to get into this morning. We'll talk with Michael Lebowitz about the Fed. They're on track to hike rates 7 or 8 times over the course of the next year. Several of those meetings slated to be 50 basis points. Can the market handle that? Can the economy handle it? We'll talk about that next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
There's a war being waged on your retirement dollar, and unless you act now, you'll lose the battle with inflation, higher taxes, and a lower standard of living. You can blunt the effects of rising prices with our next workshop on combating inflation in retirement, April 2nd at the Embassy Suites Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement with Ratliff and Rosso. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Of course, it is Tuesday Tuesday, man. Let's try that again. It's Thursday as we wrap up the week. Also wrapping up the quarter now. April the 1st is Friday. Yes, I know that's April Fool's Day.
No fooling.
No fooling. Absolutely right. Also, too, that is going to be, still part of this kind of portfolio rebalancing process that we've been in for the last, couple of weeks. This is something we talked about at the beginning of the month. We had written about this several times. Markets were, under a lot of pressure. We had the Russia-Ukraine thing going on. There's lots of panic. We're getting lots of emails and people panicking about, oh my gosh, we're in a bear market and this is, terrible and everything's going to go down. We need to be, all in gold and commodities and these type of things. And we warned back then that, first of all, when you have 2 negative months in the market in a row, that's a rarity. That doesn't happen all the time, that you have 2 negative months in a row. And so you're likely going to get a reflexive rally. And plus, combined with the fact we had a tremendous amount of negative sentiment, a very, very low equity exposure in terms of, portfolio managers, hedge fund manager, pensions, those equity exposures were extremely low. And we'd said back then that all it would take is, some type of good news, the Fed just to kind of, maintain their stance, not do anything that surprises the markets. And that's what they did. And ever since that Fed meeting, the markets have been, pretty much on a tear because the Fed didn't really do anything other than just kind of reaffirm that they're just going to be on their schedule for hiking rates. Now, how long this lasts, of course, is a question of how far the Fed's going to ultimately hike rates. But as we move into April, the seasonal strength of the market is still there. And the first day of April tends to be the day that, we see a lot of mutual fund managers put money to work as well for the new quarter. So don't be surprised that, if this week the market continues to try to work its way a bit higher, particularly on the NASDAQ, where it's a lot of these real beaten up stocks. The meme stock chases back a lot of the, short positions that have been built, and those in like the ARK type funds are being unwound. And so we're seeing really big moves. Even ARK itself has finally plugged some of its leaks, as I said yesterday, and has been, rallying fairly strongly here. But be careful about this, because this is that kind of reflexive, fueled rally that we had discussed earlier this month. It's not a return of the bull market, and that's, at least not now. Now, are there some things that could occur to change that? And the answer is yes. If the market can hold the 200-day moving average, build some support there, work off an oversold condition, then break out to new highs, you're back into a bullish trend. So, all this commentary that we're talking about now, that'll change. But the market does have a lot to deal with over the course of this year as we move forward, because it's not just the Fed hiking rates. It is also all this liquidity that we put into the markets over the last 2 years, that $5 trillion, the checks to households, all of that, has gone, right? There is no more of those benefits. There's no more bill on the horizon for more benefits being sent to households. That's behind us now. The fact that you have inflation running at very high levels because of that monetary infusion, right? No supply, lots of demand because I gave everybody cash. Not surprising you get inflation, but that's also impacting households, so they'll start spending less. So you're going to have a tighter monetary environment. Even if the Fed does nothing, monetary policy is already tighter because interest rates have gone up. The 30-year mortgage is near 5% now. Oh my gosh, highest level we've seen since I think 2018. So, these are things that are going on, and that is all slowing economic growth. So now the important thing here is now the Fed's talking about hiking rates 50 basis points at the next meeting in May, 3 50 basis point rate hikes before the end of this year, and 7 rate hikes in total. So a 50 basis point hike is 2 rate hikes, 2 quarter point rate hikes. So you're talking 7 to 8 rate hikes going into 2023, and the question becomes really, with everything else already getting tighter, can the markets, handle that further tightening of policy in a slowing economic environment? Michael Lebowitz joining us this morning to talk a little bit about that. Mike, welcome to the show.
Thank you for having me.
Sure. Go ahead.
So back to your earlier comment, I think this is a very important time to be agnostic, not necessarily be a bull, not be a bear, be the eagle, as we like to say, because there's a lot of, look, we've been in a bull market for the better part of 10 plus years, right? Coming out of the 2008, 2009 crisis. And we had a little speed bump in 2020 where the market, some people will claim it was a bear market, but it lasted a whole 10 minutes and then bounced right back. And we had a great year and a half after that. So I think the argument that we're still in a bull market has some merit. I think the argument that we're entering a bear market probably has a little more merit because, in large part, what you said, Lance, about the Fed pulling liquidity, about the government not spending nearly as much money as they were. And this is going on globally, too. It's not just within the confines of the United States. So, I think it's very important to be understanding of the bull view, understanding the bear view, and be agnostic and watch the market, because bear markets are tricky to trade. We have written on this a couple times. We've talked about it. Bear markets are kind of like stair steps. They'll have a sharp drop. They will consolidate. And sometimes those consolidations can be really sharp rallies. And those rallies create hope, and they get investors to jump back in. And then the bottom falls out again. And you can get 3 or 4 of these 20% drops followed by 10, 15, 20% increases or even more, and then drops again. So,
and by the way, we saw that is the type of action you see. If you go back to the dot-com crisis as an example, you saw exactly that same type of action where you would have these declines of 10, 15, 20%. The markets would rally, and the media would be saying, hey, time to get back in. The bull market's back. That correction's over, thank goodness. And it would just suck everybody back into the markets just in time for it to drop again and kind of hand their hats back to them. And that went over and over and over again. And I remember clearly Ralph Alcampour, they changed his name to Ralph Make You Poorer, because every time the market rallied, he kept saying, hey, the bear market's over, time to get back in. And he kept telling everybody to buy the top all the way back down again. And, this was, and that by the time we got to the end of the dot-com crisis, it was like nobody wanted to be in stocks anymore. And, we saw a little bit of the same thing occurring in 2008 as well. But, that the drop was so sharp once Lehman kicked in, there was really not much to talk about after the fact.
Right. And usually bear market ends when all the greed has been wiped out of the market and everyone is fearful.
Yeah.
Everyone thinks the market's zero, that there's no hope, that there's no bottom in sight. Yeah. And that's when markets usually bottom. And now, Lance, to your point earlier, there's something different about this bear market that we did see this in '08, but not in 2000 or before that. And that's the Fed has discovered quantitative easing. And they, along with the U.S. Treasury, have now understand how to print money, writing checks to the people funded by the Federal Reserve. So what really matters to me when I try to think about bull versus bear market, where are we going, is what's the Fed doing? And like you said, they're talking about raising rates potentially in 50 basis point increments 3 times, I think, is now the guesstimate, and then raise rates up to about 2% by the end of the year, and then possibly 2.50 to 3% by the end of 2023. I think what's more important, and I think it's May 3rd, May 4th is the next Fed meeting, is not necessarily whether they go 50 or 25. I think the market can handle 50. The market is expecting 50, assuming nothing changes between now and then. I think the big one is, what will they do with their balance sheet? Will they make an announcement regarding QT, quantitative tightening? Quantitative tightening is the opposite of quantitative easing. Quantitative tightening means that they are either selling or letting bonds mature out of their balance sheet so that the amount of holdings actually declines over time. How that works, at what pace they will do it, matters, but what matters is they are pulling liquidity from the market. There will be more treasuries the market has to absorb. When it has to absorb more treasury bonds, it can absorb less losses.
Yeah, and that's an important point here too, because when the Fed was hiking rates back in 2018, they hadn't reduced their balance sheet yet. So in 2017, they started hiking rates, and we saw rates, going up. Fed's hiking rates, and everything's fine. Market's doing okay, and we got the Trump tax cuts, and at the bottom of the market, and at the bottom of 2017, and that gave a lot of lift to the markets going in early 2018. But it wasn't really until the Fed started tapering their balance sheet and they started talking about being nowhere near the neutral rate, and that was where the market really kind of started to come to the realization of a change in the dynamics, and we had that big 20% correction heading into December. And then, of course, immediately, as soon as we get there, it's like, oh, we're done hiking rates. And by July of next year, the Fed's already back to dropping rates to zero. We're bailing out hedge funds through a kind of a backdoor QE through reverse repo. And, kind of was game over by the time that we got into 2020. So we'll be right back after the break. Shifting gears here a bit as we start kind of talking about, kind of the markets and dynamics. One of the things that has been fueling the market has been a lot of bullish sentiment. And the question is, and the difference between the 2020 sell-off, which was a correction and not a bear market, even though it was 35%, was that psychology to it. We'll talk about psychology, what's happening in the markets today, and, is there a difference? Be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
There's a war being waged on your retirement dollar, and unless you act now, you'll lose the battle with inflation, higher taxes, and a lower standard of living. You can blunt the effects of rising prices with our next workshop on combating inflation in retirement. April 2nd at the Embassy Suites Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
An energy rebate equating to $100 a month for individuals. Now, my daughter would love this. She was just complaining about filling up her car.
Was she complaining about that while she's standing in line waiting on a $6 cup of coffee?
No.
The Real Investment Show podcast.
The gym that she goes to,
Yeah.
it is literally, ladies and gentlemen, 300 yards down the street to the gym. She drives. So I'm letting her learn her lesson about being frugal.
At realinvestmentadvice.com.
Learn to use your feet, Flintstone.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
You can blunt the effects of rising prices with our next workshop on combating inflation in retirement. April 2nd at the Embassy Suites Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning at 6:33 as we get today's edition of the show underway. Michael Lebowitz joining us this morning. Bryn Clanton driving our Lynch Challenge bus. My wife, yesterday I get home and she says, I was listening to your show on the way to work. And it was so boring because you're just talking money. Talk about something fun and exciting. So I've got to figure out something fun and exciting to talk about this
we
segment.
had a pretty good repertoire yesterday.
Well, we did. In the 6:15 to 6:30 break, we had it going on, right?
Yeah.
And we had a good conversation going. 6:30, we were actually talking about important things.
Yeah.
Right. So I was telling.
Don't feel bad. I get the same reaction from my wife, too.
But this is the problem about money, right? You talk about money, everybody's like, ah.
At least your wife listens to the show, Lance.
The only reason she listens to the show is to make sure I'm not saying anything bad about her. That's it, because
it's a defensive measure,
right? So, and as you may or may not know, by the way, my wife actually works in the same building as me now. Her office is directly above my desk. So I like walk around during the day, and when I hear her walk around in her heels, I bang on the ceiling with a broom. So
well, that's some kind of karma.
Yeah, it's kind of like the apartments in New York, right? Keep it down.
Lance, I have a question for you.
Yeah.
How many articles do you write a week? 4?
4.
3? 4.
Yeah.
How many of those does your wife read?
None.
0. Ever.
How
many ever?
Mike, I'm not even actually sure she knows the name of the website. So let's start there. Realinvestmentadvice.com. If you haven't been by there, that's where it's all happening.
What if you were to write some
You're
articles?
making me feel better.
What if you were to write some articles about nat gas?
Well, now that, oh, by the way, we had the most interesting conversation last night about nat gas. Remember the other morning we're on the show and we were talking about the fact that, she's in the midst of this big deal, and that, selling this, what they call premium natural gas, which is kind of natural gas generated from cows and pigs. Good stuff. Cows and pigs. It's from farm animals, right? It's a special process of natural gas.
It's green gas.
It's great. It is. It's green gas and it's premium, right? And so, normal natural gas is like $40 an MMBTU, and this stuff is like $105, right? It's just a massive difference.
Wow.
But with it, when you buy this, you get these carbon tax, you get these receipts, right? That you then submit to the government so you can pollute elsewhere.
Right.
And so she's on the phone with a guy to buy this, product that she needs for one of her customers. And the guy says, you know what, do they really want the gas or do they just want the certificates?
Bingo.
And she's like, you're kidding, right? And he's like, no, we'll just sell them the certificates. They don't even need to buy them. And this is my point about this whole green energy scam, which it is. It's a whole scam, right? I mean, the stuff you're getting sucked into is going to be a millennial problem. And I'm young Erica sitting here across from me, and she drove her Tesla down over the weekend. And, they have no idea the trap that they're walking into. But this is the way this whole scam works, right? Mike has a business that is a major, he's a coal miner, right? He's from Maryland. He's up there. He's mining coal. He's polluting the planet left and right. But he's now got to report for the SEC. The SEC is now passing all these new standards that not only does Mike have to report his carbon footprint, he also has to report the carbon footprint for every one of his suppliers as well as part of his quarterly reporting. Now, this isn't going to drive up the cost of corporate filings at all. Not like Sarbanes-Oxley did after Enron, which added an extra $1 trillion in reporting costs. But Mike's going to have to do this. Well, in order for Mike to continue to pollute, all he has to do is go to Erica over here, who has, basically she runs a pig farm, and she sells her premium natural gas that she creates from her pigs and cows. And she just sells a certificate. She sells the gas to somebody else. She collects that revenue, and then she sells the certificates that she gets from the government to Mike. These are called carbon credits. And Mike says, okay, great. So Mike pays her a premium for her carbon credits. She sells the carbon credits to Mike. Mike continues to pollute the planet left and right, but then he gets to report much lower ESG scores because he has carbon credits. That, ladies and gentlemen, is how the scam works.
And the incentives to come up with better alternatives are not great.
No. Why? Why would I come up with a better alternative if I can just buy credits?
Well, look at what's going on now, right? This morning or last night, Biden's releasing oil from the oil reserves. What does that do? That brings down the price of oil. It basically says, hey, use all the oil you want. So they're, in the quest to win votes, they're not creating the right incentives to go out and find the next true energy source that can drive our cars and run our factories. And that's the bigger problem, is that this country focuses on the here and the now, and we like to pay lip service to all these grandiose ideas. But if we were to start focusing on our future, we could allocate money. We could be a lot more productive, focusing on today, but thinking about tomorrow, as opposed to trying to win votes next November.
But Mike, that's exactly the point and case, which is, look, Toyota, as a good example, has had a hybrid car for some time now. It was ugly, right? Prius, nobody wanted to drive it, but as you drove the car, it had an electric motor in it. So when you braked, it would charge the electric motor and it would reduce the carbon emission from the car. Great idea. And, if you wanted to make the change to electric vehicles, because even Tesla has now admitted this, Elon Musk has said in 2 to 3 years, there will not be enough materials and enough batteries to support the EV movement. It's just not, we can't mine the planet fast enough for that and at the rate that we're going. And that's the other thing, right? Besides all this is, it's great to be, to be environmentally conscious. That's awesome. Has anybody considered the impact of mining the planet for all of these rare earth materials that it requires to do this. So, I mean, it's great. Let's destroy the planet in the process of being green.
Let's
a great
destroy
idea.
it another way.
It's a great idea, but hold on a second. But, you know, the problem is that we had this, you know, Toyota kind of laid the footprint, and what we should have done is to make this move to electric vehicles is move to hybrids first, allow time for the industry to catch up and create better batteries, more efficient batteries, or better alternatives for electric vehicles, and migrate slowly into the electric vehicle plan. If that's where we're going to wind up, I think ultimately we wind up with some other type of fuel. But you know, if that was going to be the process, we should have had a logical stair step into moving in that direction, rather than this kind of all one move that we've tried to do that is now we're going to pay back consequences for that over the course of the next decade.
Well, isn't one of the big consequences that we're now all these auto companies are basically all their investment is going into electric vehicles instead of something that truly is green, right? Electric vehicles are green, but only in the sense that Texas won't be dotted with oil fields. There'll be holes all over the ground in, you know, Africa and wherever else they mine these metals. You're just polluting the planet in a different way. And all those metals have to be shipped. They also have to be discarded. So, you know, we can have a debate all day on which pollution is better. They're both harming the earth.
Right.
One may be a little better, one may be a little worse, but I don't believe either one is the true answer for the next 100 years.
Well, and look, you're not getting away from petroleum anyway. I mean, you know, the whole idea is great. But it takes petroleum products to build the battery, right? I mean, you know, the amount of petroleum used to build a car is phenomenal. I mean, the carbon footprint of an electric vehicle is not that much different than an ICE vehicle at the end of the day.
Right. It's everything. Everything that the microphone I'm talking into, the computer I'm looking at, the clothes I'm wearing. It's everything. And you're right. We're not going to get out of it. And it's, you know, but even for cars, even for motors, the real answer, in my opinion, hasn't been found yet. And we're taking away the incentive to find it because now you can make a lot of money on electric vehicles. So the auto companies pour all their money into electric vehicles instead of looking at hydrogen or, you know, whatever else may be an option that actually solves the Earth's needs.
But look, Ford, GM, Porsche, all these companies, they're simply responding to market demand. And, you know, one thing that Tesla did was they created a market demand for an electric vehicle, right? And so all these other companies are saying, hey, you know, there's an opportunity to build an electric car. People obviously want that. And you know, there's a place that we can sell it. Now, as soon as that demand changes for any reason whatsoever, these big auto companies will change and they'll produce whatever's next. You know, so all these auto companies are just simply responding to what market demand seems to be at the time. And again, you're right. You know, they're not looking at developing the next alternative or a better alternative. They're just responding to market demand and what makes profits, and more importantly, what makes their share price go up.
And what's interesting, compare the Prius. The Tesla is a beautiful car. It came out as a beautiful car. If you look at all these new electric vehicles, they're all really good-looking cars. There are no boxy sedans. There are no Priuses. There are no Civics. There are no just standard cars. And some of that is the allure, right? It's not just I'm green, I'm driving a Tesla or a Ford Mustang or whatever, you know, the new electric cars are. I'm driving a beautiful car. And some of that allure is what's sucking people in too. And the fact that they can put the bumper sticker on their car that says, I'm green, look at me.
So
and go back to their 10,000 square foot house.
If I can only figure out how I can get a carbon credit, that'll be the next thing. Anyway, buy pigs. Start raising them in your backyard. That's the new solution to making money. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
There's a war being waged on your retirement dollar, and unless you act now, you'll lose the battle with inflation, higher taxes, and a lower standard of living. You can blunt the effects of rising prices with our next workshop on combating inflation in retirement. April 2nd at the Embassy Suites Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So that didn't take very long. One of my clients just texted me and says, "So, David, how do you actually capture the gas?" The manure is captured in buildings and under the floor facilities, then flushed to an anaerobic digester called a covered lagoon, which looks like a large tarp covering the ground. Inside the lagoon, solid hog waste is broken down by bacteria, thereby releasing the methane gas, which is then collected. So there you go. All you have to have is a lagoon. And there's actually a video here of a 2.2 billion cubic foot of natural gas in 88 lagoons. That's a lot of pig crap. That's all I'm saying. And by the way, I'm not sure exactly just how premium pig manure is. Have you seen pigs eat everything, including humans, by the way? That's how they used to get rid of people back in the day. They would just, kill somebody, throw them in the pig bin, and
next morning they're gone.
They're gone. Just and everything, bones, you name it, gone. There's like no tray. Hats, boots, done. So,
yep. That's how you
Thank you, David, because I was more concerned how the capture process worked, too. I had something else in my mind.
No, it's not funnels and hoses. So, anyway, all right. I said before the last break, just to entertain my wife on her drive into work this morning, that we want to talk a little bit about the March meltdown. And look, there's one important difference. Back in March of 2020, markets were down 35%. Now, two things were occurring at that time that, one you would expect, one you didn't expect. And the first one expected, of course, is when the market started melting down, the Fed panicked, and they immediately jumped back into doing QE. This is now their modus operandi. As soon as there's any trouble in the financial markets, and Mike and I have this ongoing debate going right now, he thinks they're going to hike rates further because he thinks that inflation's their bigger concern. My bet is as soon as this market really shows any signs of fractional crack in terms of the financial stability, they're going to be jumping back in to do QE and to bail out the banks, because that's who owns them, is the banks. So, first line of defense is that they're going to bail out the banks. Anyway, that's not the point. Back in March of 2020, when the market broke, the reason that was a correction and not a bear market, look, I know the market was down 35% and the kind of technical measure, and it's completely arbitrary, is that a 20% decline is a bear market. Back in the day, when Mike and I were growing up in the business, a 20% decline would break the previous bull market trend, right? It was just markets weren't that deviated from long-term means and exponential growth trends and those type of things. So if you had a 20% decline, you would crack those trends and you would be in a bear market. You would have a directional change in prices over time, and that would be a bear market. Today, that 35% correction only got you back to the long-term bullish trend from 2009. So it wasn't technically a bear market. And secondly, the reason you know it wasn't a bear market, and Mike alluded to this earlier, is that as soon as we got down to the bottom, people couldn't wait to buy stocks. And they weren't just buying stocks. They were buying the worst of the worst. They were buying companies that were being bailed out, on the verge of bankruptcy, or about to be in bankruptcy. I mean, it's just the speculative fervor in the markets that occurred as soon as the Fed started doing QE was amazing. And that tells you also that we didn't change that psychology of the market to a bearish tone, which really just reflected the fact that we were in a bull market. And that's really kind of the key flavor here as well. And as we were talking about earlier this year, is that, look, we had this 10, 12% decline. And yeah, a lot of people were really negative about the market. But as soon as the market bottomed here, we saw people running right back in to buy, AMC and GameStop and the most speculative of assets. People jump back in. We had this big rally over the last 2 weeks. So it tells you that we're still in a bull market. We haven't gotten to that bear market mentality because nobody wants to buy stock. When you're in a bear market, Mike said this earlier, everybody thinks the market's going to zero. They're not going in and buying, meme stocks. Mike, go ahead. I'm sorry, cut you off.
I would also say there's a fundamental side to that too. The old F word, which no one likes anymore, fundamentals.
Right.
And that is that, in 2020, fundamental valuation ratios, whether it's price to earnings, price to sales, there's a whole bunch of them. None of them got what we would call cheap. Some cases they got to fair value, but I wouldn't quite call fair value a bear market when things get to where they're fairly priced. That's where they should be. And so, you look at the technical deviation and how it corrected, and you look at the fundamental deviation and how they corrected. And in both cases, best case scenarios, you only got back to where the market should have been based on both long-term technical trends and long-term fundamental trends. And once again, we bounced off the bottom. There was no fear to be found, right? Like, they weren't buying the most conservative stocks. They weren't buying the Procter & Gamble's. They were buying the AMCs, the GameStops, the junkiest of the junk. Right. And those stocks had incredible rallies in 2020.
And also, this is one of the things that kind of cracks me up about the media is you'll hear this a lot. And Mike, I know you've heard this, is they go, valuations corrected back to where they were in 2019 or pre-pandemic, right? And it's like, yeah, and they were expensive then too. In January, February of 2020, Mike and I were writing articles about taking money off the table and reducing risk because valuations very extended. We were in the midst of kind of a market melt up at that point. And, we only thought we were melting up then. And now, we've reverted all the way back to those expensive levels of valuation. And now we're saying, oh, markets have corrected. We're back to a good buying opportunity. No, we're still expensive. Forward valuations are still expensive. Long-term valuations are still very expensive. A lot of these companies that, even on the value side, Mike and I have talked about this, companies like Procter & Gamble, it's a great company. It's trading massively expensive. These are not value stocks anymore in terms of the true words of value.
Well, the true words of value now is passive. So passive means that you buy the biggest value ETF and you just assume you're buying value. Because you're buying companies like Procter & Gamble and Clorox and companies that do have a nice steady stream of earnings. And if you look at them, their earnings follow a nice predictable line. And, at first blush, you'd say, yeah, that's a value company. But when you look at the price, it deviates well above that earnings trend. And that's the problem with a lot of quote unquote value stocks that end up in value ETFs.
Right.
The true value stocks are the ones that are getting beaten up despite these good earnings and earnings trends. And those are the ones that are still being left by the side of the road that aren't being bought because the value investors are now passive too. They're not looking. There aren't enough of them to buy those really cheap stocks. And we've uncovered a bunch of them, in some of our 5 for Friday reports in SimpleVisor that are just dirt cheap, but they're not rallying. People would rather buy these stocks that really have no hope for the future, but they're very volatile. They're
Right.
very volatile.
Well, and this is that gambling mentality that we've created, ever since, really 2020 with, sending checks to households and the Robinhood app. And, we set these millennials up to, ultimately fail, unfortunately. But, this is that mentality we've created in the markets. And again, buying value is boring. It doesn't go up 30, 40% in a day. Why would I own something that goes up 5 or 6% a year when I can make that in a day if I own a NVIDIA or an AMD that can, jump 10% in a day? And that's one of the challenges that we face in managing money for our clients, is that we've got to have some of those companies in our portfolio. We don't like it, but we have to have it because we need that beta volatility to make sure our portfolio is performing with the markets. And it's a risk that we have to understand. It's a risk we have to control, but it's also something that we're forced into doing. And this is one of the big challenges for advisors, period, which is this, career risk that they face. And what career risk is simply that if I don't keep up with the markets, if I'm not matching what the benchmark is doing, I potentially suffer career risk. In other words, I lose my clients to somebody else who will, even if that's doing the right thing. If being in cash was the right thing to do, that gets trumped by my business going out of business because all my clients leave to go somebody else who will chase meme stocks, right? And so that's the big challenge for financial advisors and investment managers, period. Doesn't matter who it is, whether you're a hedge fund, a mutual fund, pension fund, an investment advisor, is that you've got to manage these risks because you're forced into taking these risks. Otherwise, you lose all your clients. And that's a very tough balance between doing what's right for the client and doing what's right to stay in business as well. And that's often a very tough line to walk.
And it catches a lot of investment managers offsides at the worst possible time. Mm-hmm. We saw that in 2008. We saw that 2000 is a great example of that. How many investment managers got caught offsides buying these tech stocks at outrageous valuations and ended up losing 50, 60, 80, 90% mm-hmm. of individual holdings and really set their clients back 10 years.
Right. Well, we were talking last night. I was just talking earlier that my wife and I watched the Smartest Guys in the Room about Enron, and that was one of the kind of the telling points about that is, all these investment analysts wouldn't ask the questions about how do you generate your revenues? Where does your income come from? Because Enron would get them fired from their brokerage firms for asking questions. And that's the job, right? And this is part of the problem that we've created in the markets through turning, financial markets into casinos. Nobody's asking the question why or how. And if more investors ask those questions, they would do better long term, but long-term investing is dead anyway. The average hold time is now down to 4 months. So
is it that long?
Yeah, I'm a long-term investor for 4 months. All right, wraps up the show for the day. We'll be back tomorrow morning for Financial Fitness Friday. Get by the website. Our new article is coming out tomorrow as well. Newsletter will be out this weekend on markets and your money. Get by the website and check out SimpleVisor, as Mike said a few moments ago. All of our portfolios there for you. RealInvestmentAdvice.com.